Financial crises don't just sneak up on us, right? That they're unpredictable shocks, black swans that blindside even the experts. But that's not how it works. Every major collapse in modern history left a trail, not of predictions, of patterns. And right now, in late 2025, those patterns are appearing again, not in headlines, in the gaps between them. And once you see what really happened before and what's happening now, you can't unsee it. Welcome to the wealth timeline, where money, power, and history quietly shape the world around us. Because the crises that matter most don't announce themselves, they accumulate. Here's what we know. In 1997, Asian currencies collapsed within weeks. In 2008, subprime mortgages triggered a global meltdown. In 2020, pandemic uncertainty froze credit markets overnight. Each time, the world was told, no one saw this coming. But that wasn't true. Central bankers had the data, regulators had the reports, analysts had the models. What they didn't have was the incentive to act, because every modern crisis follows the same structure. A system becomes too big to question. The benefits are immediate, the risks are deferred, and by the time the risks materialize, it's too late to reverse course. What no one noticed was the cost of waiting. Let's go back to 2008. When Lehman Brothers collapsed, the global financial system nearly followed. Governments responded with unprecedented intervention, trillions in liquidity, zero interest rates, quantitative easing on a scale never attempted before. It worked. Markets stabilized, credit resumed, growth returned. But here's what decision makers believed at the time, that these measures were temporary, emergency tools to prevent collapse, not permanent fixtures of the global economy. The Federal Reserve, the European Central Bank, the Bank of Japan, all assumed they'd unwind these programs within a few years. They didn't, because every time they tried, markets convulsed. So the emergency became the norm. Interest rates stayed near zero for over a decade. Central bank balance sheets ballooned from $6 trillion in 2007 to over $30 trillion by 2021. And an entire generation of investors, policymakers, and institutions learned to operate under one assumption, that liquidity would always be there. It worked, but only under conditions that would not last. From 2010 to 2021, the system expanded. Corporate debt doubled. Stock valuations reached historic highs. Pension funds, unable to find yield in bonds, piled into riskier assets. Governments, facing aging populations and rising costs, borrowed freely because interest payments were negligible. This wasn't reckless, it was rational. Under the prevailing conditions, it made sense, but each success introduced a side effect. Asset prices became detached from earnings. Zombie companies, firms that couldn't cover interest costs without new borrowing, proliferated. Developing nations, lured by cheap dollar credit, accumulated debt in currencies they didn't control. These weren't failures. They were features of a system optimized for short-term stability. And the stronger it became, the harder it was to stop. By 2022, inflation returned. Not the mild, manageable kind central banks preferred, the kind that threatened purchasing power, political stability, and institutional credibility. So they did what they had to. They raised rates. From near zero to over 5% in less than 18 months, the fastest tightening cycle in modern history. Markets adjusted, sort of. Regional banks failed in the US Credit Suisse collapsed in Europe. Commercial real estate values plummeted, but the system held. And that's when the real problem became clear, because the cracks weren't in what broke, they were in what stayed standing. Governments couldn't reduce spending. Debt service costs were rising too fast. Corporations couldn't deleverage. Refinancing at higher rates meant choosing between investment and survival. Pension funds couldn't rebalance. They were already overexposed, and selling into a downturn would lock in losses. Nothing collapsed. And that was the problem, because when a system can't fail, it can't correct. Now we're in late 2025. Rates have stabilized, inflation has cooled, markets are calm on the surface, but beneath it, the pressures are compounding. In China, local government debt has reached 94 trillion yuan, roughly $13 trillion with no clear path to repayment. Property developers, once the engine of growth, are insolvent. In Europe, energy costs remain structurally higher than pre-2022 levels. Industrial output is stagnant. Fiscal deficits are widening. In the United States, the federal government is spending $1 trillion per year just on interest payments. That's more than defense, more than Medicare. And here's the thing. None of this is secret. Central banks publish the data. Credit agencies issue the warnings. Think tanks model the scenarios. But no institution has the political or economic flexibility to act preemptively. Because acting means admitting the system is fragile, and fragile systems depend on confidence. From this point on, the outcome was no longer optional. When liquidity tightens, something has to give. In 1997, it was Southeast Asia. In 2008, it was subprime homeowners. In 2011, it was Southern Europe. Each time, the cost was absorbed by those with the least ability to resist, emerging markets that borrowed in dollars, workers whose wages stagnated while asset prices soared, savers who watched inflation erode what central banks promised to protect. Meanwhile, those closest to capital flows, financial institutions, sovereign wealth funds, multinational corporations, adapted. They didn't cause the crisis. They responded to the incentives the system created. And when the dust settled, they held more assets, more influence, more structural advantage than before. This isn't about villainy, it's about velocity. Those who can move capital quickly benefit from instability. Those who cannot, don't. So where does that leave us in 2026? We're not predicting a crash. We're identifying a pattern. Debt levels that can't be serviced without low rates, central banks that can't lower rates without reigniting inflation, governments that can't cut spending without triggering political unrest. This is what economists call a policy trilemma. And history suggests that when all options are bad, decision makers delay. They wait for growth to solve the problem. They hope external shocks don't materialize. They optimize for the next quarter, the next election, the next board meeting, until waiting becomes the crisis. Because history doesn't repeat events, it repeats incentives. And right now, the incentive is to avoid the hard decision, even though avoiding it makes the eventual decision harder. Here's what we know for certain. Systems built on deferred costs eventually face them. And when they do, the redistribution isn't random. It follows the same channels it always has, from those who hold debt to those who hold assets, from those who depend on stability to those who profit from change. That's not cynicism, it's structure. If you enjoyed uncovering this hidden chapter of history, make sure to like this video, subscribe to the Wealth Timeline, and turn on the bell icon, because the next story might just change how you see power itself.